I'm Shil Shah, Group Head of Tax Planning at Skybound Wealth Management. I lead our global tax planning strategy across the UK, Europe, the Middle East, and beyond, supporting internationally mobile executives, founders, entrepreneurs, and families navigating complex cross-border decisions. Before joining Skybound, I spent nearly a decade advising at Deloitte and KPMG, and later within one of the UK's largest financial advice groups, specializing in UK residency, domicile, inheritance tax, and cross-border structuring. In this session, we're going to discuss something that appears simple, but in reality is anything but leaving the UK properly, not emotionally, not administratively, but from a tax perspective. Because the most expensive mistakes I see are rarely aggressive strategies. They're assumptions made during transition. In the next 15 to 20 minutes, I'll walk you through how UK tax residency is actually broken, why the year you leave is uniquely sensitive, what temporary non-residence really means, and why the 18-month window around departure often determines outcomes years later. If you are planning to move abroad or have recently left, this session will give you clarity on what needs reviewing before decisions become fixed. Let's start with the assumption that causes most of the damage. The assumption: when someone leaves the UK, the move feels decisive. Flights are booked, contracts are signed, homes are rented abroad, life shifts, and almost immediately, a quiet assumption forms. I've left, so I'm no longer UK tax resident. But UK tax residency does not operate on intention. It operates on structure. And that distinction is critical. So how does the UK actually determine residency? Before we talk about income, asset sales, we need to answer one simple question. How does the UK decide whether you are resident? And the answer is the Statutory Residence Test. It is not discretionary, it's not subjective, it is mechanical, and it works in 3 layers. Number 1, the automatic overseas test. Number 2, the automatic UK residence test. And number 3, the sufficient ties test. Firstly, you need to check the automatic overseas tests. These are the "you are definitely non-resident" gateways. In simple terms, they cover situations where your UK presence is genuinely limited. Either you're here for only a very small number of days, especially if you were non-resident in recent years, or you've left the UK to work full-time overseas and keep both your UK days and your UK work days tightly controlled. If you meet any of these, you stop. You are non-UK resident. If none of the overseas tests apply, you then move to the automatic UK test. These are the "you are definitely UK resident" gateways. They're triggered by clear UK anchoring, spending 183 days or more in the UK, having your only home in the UK in the way the rules define it, or working full-time in the UK. If you meet any one of these, then you stop. In this case, you are UK tax resident. Only if neither of these sets decide, you then go to the sufficient ties test. And this is where most exposure arises. The sufficient ties test in practice. The sufficient ties test looks at specific UK connections: a family tie, an accommodation tie, a work tie, a 90-day tie, and sometimes a country tie. The more ties you have, the fewer UK days you can spend before becoming UK tax resident. Now let's apply this properly. Imagine you leave the UK in October. You take up full-time employment in Dubai. You rent an apartment there. But your UK home remains available. Your spouse stays temporarily in the UK. You return for meetings throughout the year. In this situation, you have a family tie, an accommodation tie, a work tie is potentially present, a 90-day tie can be possible. Well, triggered from prior years. And by that point, your permitted UK day count may be very, very limited. You can live abroad, earn abroad, pay tax abroad, and still be UK tax resident. Residency is mathematical, not emotional. The exit year, where timing really matters. Now that we understand how residency is broken, we need to discuss something even more sensitive. The year you leave. The UK tax year runs from the 6th of April to the 5th of April. If you leave part way through a tax year, the year is not automatically split. Split year treatment applies only if specific conditions are met. Now, there are 8 possible split year cases, and you only get split year treatment if you meet one of them. Some relate to starting full-time work abroad. Some relate to ceasing UK employment. Some relate to accompanying a spouse. If you qualify, the year is divided into a UK resident portion and a non-resident portion. If you do not qualify, the entire year may still remain UK tax resident. Now let's look at this practically. You leave in September, your bonus is paid in March, your shares vest in February, maybe you dispose of investment property in January. If split year treatment is not correctly secured, that income may remain fully within UK tax scope, even if you were physically overseas. Once the tax year closes, the position is largely fixed. The exit year is the only year you do not get to replay. Temporary non-residence, the 5-year illusion. Even if residency is broken properly, the story does not necessarily end there. The UK has something we call temporary non-residence anti-avoidance rules. These apply if someone leaves and returns within 5 tax years. Let me illustrate with an example. You leave the UK, 2 years later, while non-resident, you sell a business. The gain is substantial. You believe it falls outside UK tax. 4 years after departure from the UK, you return. Now, under temporary non-residence anti-avoidance rules, some gains, in particular scenarios, realized while non-resident can be treated as arising in the year of return, depending on the facts. This most commonly comes up on share disposals, business exits, and other significant capital gains. So you can feel confident for several years and then return to the UK and find that the gain has not actually disappeared. It's just been deferred. For founders and senior executives planning liquidity events like this is really, really important. Future intentions must be factored into your departure strategy. A good exit versus a poorly structured exit. Let's contrast 2 departures. In the first scenario, residency is reviewed in advance. Split year qualification is confirmed. Income is sequenced properly. Asset disposals are timed carefully. Return intentions are considered. In the second scenario, the move happens first. Tax review happens later. Income might arrive without sequencing. Assets are sold shortly after departure. Temporary rules are not considered. The difference may not be visible immediately. It often happens years later. One is structured, the other is reactive, which leads us to the 18-month window. When you step back, a pattern emerges. It is not just about the departure date. It is about the surrounding period, the tax year before leaving, the tax year of departure, the tax year after. Within this window, residency status is determined, income is sequenced, gains may be triggered, long-term exposures are set. So once those years close, flexibility reduces significantly. Planning after departure is often damage control, whereas planning before departure is strategy. If you are planning to leave the UK, 5 areas should be reviewed: day counts and sufficient ties, qualification for split year treatment, the timing of bonuses and shares vesting, planned asset disposals, long-term intentions regarding return. You do not need to memorize legislation, but you do need certainty. Leaving the UK properly is not about geography, it's about structure and timing. The biggest cross-border tax mistakes are rarely aggressive schemes, they're just assumptions made during your transition. If you found this session valuable, there will be more sessions in this series covering returning to the UK, capital gains and UK property, inheritance tax reforms, and cross-border planning for zero tax jurisdictions. You can subscribe to stay informed as new sessions are released, and you can follow Skybound Wealth Management for ongoing insights across our platforms. And if you would like clarity on your own position before or after, you're welcome to reach out to us directly. Cross-border tax does not need to be overwhelming, but it does need to be structured. Thank you for watching.